A comic is a man who says funny things. A comedian is a man who says things funnily. Frivolity aside, my guest believes that investing in emerging markets is no laughing matter, but in fact should be a central concern for all investors worldwide. With me today, an economist, entrepreneur, author, and an emerging market evangelist, Jerome Booth. Jerome, welcome to our show.
Thank you very much.
Jerome, the Yanks have a saying, wake up and smell the coffee.
Mm-hmm.
Is that what your book is aiming at? People should smell the coffee?
In a sense, what I'm saying is that the finance theory that we use is not fit for purpose. This isn't necessarily a statement against academics, but as Milton Friedman said, is if a theory has neither realistic assumptions nor testable results, then it's useless. And a lot of finance theory falls, maybe technically correct, but it falls under that category. And so it's the widespread use of that theory in inappropriate ways which has effectively affected asset allocation on a global scale, affecting hundreds of millions of people. And this is wrong. And we need to change it. So yes, we do need to smell the coffee. And the biggest problem of all in asset allocation globally for investors is the agency problem, that people are managing other people's money and they have different incentives. And one of the biggest problem is that they use the theory in the knowledge that it's not fit for purpose, but because everybody else does. And
herd mentality.
Yes, there is a huge herd mentality.
Yeah, but let's take you, what is the central premise? The risk is wrongly allocated because
yes.
Developed markets are as risky as emerging markets?
Yes, I've got in the book there's a whole section on some economics and the history of economics, if you like, explaining the world that we live in today. There's a section on a whole chapter on risk. Risk, I call it a four-letter word.
Right.
and it's
risk
something
is not volatility, though.
No, there's big differences between risk and uncertainty. Keynes and Knight agreed in this definition, at least, that when you have random events and you know the probability distribution, that's risk because you can hedge and insure it. Uncertainty is where you don't know that probability distribution. It may not exist. Frank Knight called them one-off events. When you have uncertainty, and this is Keynes's general theory, a large amount of uncertainty will mean that entrepreneurs will not employ people, will not generate employment or investment. And that itself has a positive feedback effect, and that's what can cause depression. So on one hand, there's a huge, and the moment that John Hicks created the classic ISLM analysis of Keynes, and that's about as technical as I'm going to get, and as I get in the book, uncertainty came out of the way that Keynes was taught. And since then, the whole of economics has been about squaring the circle. There are some big differences between macroeconomics and microeconomics, and yet we've had not just the Chicago school, but the new Keynesian school trying to fit, the two together with the micro foundations of macroeconomics.
Break down the Greek for us. Break down the Greek for us. Developed markets have a problem, according to you.
Yes.
What is the problem?
Well, the problem is that we have depression-like conditions, which is what I was coming on to say about uncertainty specifically. And we have just way, way too much debt. The average for what I call heavily indebted developed countries, which of course is a because somebody else called rather condescendingly a group of countries heavily indebted poor countries. So I call them heavily indebted developed countries. The average debt to GDP is 270%. Now, when England had a debt to GDP of 240% after beating Napoleon, it took the best part of a century, certainly half a century, to get down to a sustainable level using fiscal policy. So that's not politically feasible today. These debts, these enormous debts, are going to be eroded by a combination of two things. First of all, and this is what's being tried today, what we call financial repression. Financial repression is any policy which captures domestic savings in order to fund the government and to do so at a lower cost to the government, lower interest rates, than otherwise possible. And what you do is you have quantitative easing, initially there to bail out banks, not to stimulate the economy, by the way, is now being used as part of that policy of financial repression. By having very low interest rates, you then have inflation higher, and that's what erodes debt over time. If financial repression doesn't work, and it's working so far, it worked very well for both Europe and the US after the Second World War, by the way, then the other policy is inflation, which is what was tried in the 70s. And again, that has negative real interest rates, that's after inflation interest rates, erodes the debt over a period of time. What I'm describing is the plan in the West to rob their savers.
It has happened before. Argentina and America aren't that different. Argentina makes headlines, you say, and America picks your pocket, perhaps. Well, after Bretton Woods broke down.
When you issue debt in your own currency, then you've got more options to rob your savers. And so that's effectively, what's happening. Of course, part of the argument is to bamboozle those in emerging markets to keep on buying US assets or European assets by saying everything's okay. And it's not okay. We are going to see a big shift in allocation, and people have to start realizing that, we said risk is not the same as uncertainty, risk is not the same as volatility. Risk is also not easy or simple, and it's different for different people. If I live in England and I invest in a US Treasury bond, that's a different risk for someone who lives in the United States, because our liabilities are different. Also, our information sets are different. Our speed of reaction are different. We may have different behavioral biases. So there are lots of different reasons why risk is not some simple linear scale, and you have at the one end, risk-free, so-called, which I call that an abuse of the English language, to call anything risk-free.
So you're saying basically the 10-year is not risk-free?
It's certainly not risk-free. There is no such thing as a risk-free investment. The average, if we just think about the 10-year US Treasury bond, the average yield on that in the last 6 decades, excluding the period, is 6%, excluding the sort of high inflation period. Well, if the Treasury bond goes to 6%, depending on your portfolio, a typical Treasury portfolio might lose a quarter of its value. On top of that, there's a currency risk. If I'm standing on the top of a hill, and I'm I'm measuring a trajectory of a bird and an aeroplane. I'm sort of looking at it going up there, and I'm measuring the distance, the angle to the land, and I'm calling that spread. I'm going to define that as spread.
Right.
And I'm thinking, well, that's okay, I understand that. And then suddenly it gets very volatile. It goes up and down and up and down. And I think, wow, this thing is about to fall out of the sky. It's all over the place. There's something seriously wrong. And then I have a revelation. I realize, actually, that thing's not the problem. The problem is I thought I was on a hill, and I'm not on a hill. I'm on a boat. And the boat was becalmed, and now we're in a gale. And it's me that's moving. If we denominate everything in terms of the relationship with the US, in terms of the relationship with the dollar, in terms of relationships with some artificially designated risk-free asset, then of course we are ignoring the potential that core, that base, has actually got a problem. And that's the reality.
Yeah. A crisis gives warnings.
Yeah.
In financial markets, crises rarely happen without a warning. What are the points that precede a liquidity event crisis?
Yeah. Yes, there are warnings, but they're often found in disciplines like macroeconomics and history and politics, not just counting volatility. So I talk about 3 warning signals.
Correct.
First of all, one has to look at the structure of the investor base. I spend a lot of time in the book talking about the structure of investor base, because I think it's more important for regulators in particular to look at that than, say, what instruments people own. Because the structure of the investor base, if it's homogeneous, can actually create systemic risk. And I'll give you an example of that, if I may. I have a son who's done a couple of degrees in economics, and at one point he came to me and he said, there's this article that says that nobody foresaw the Thai crisis in '97. And I was scratching my head thinking, well, that's wrong, because I remember it. And so why would someone say that, an academic say that? And the answer was, well, because the spreads only blew out at the last minute. And I was thinking about this. No, that doesn't mean that nobody saw it. It means that some people didn't see it.
Right.
And what was actually happening in Thailand was that people who understood balance of payments crisis, the IMF, and let's face it, people who read the news, because Soros had a huge unsuccessful speculative attack, so it was very much in the public domain that there was a problem. And those people exited, and other people who just saw an arbitrage just went more in. And so you had, as they put more money in and other people took money out, the spread itself didn't really move until eventually you had all the same type of people owning the bonds. And then, when they all got it,
they all wanted to
they all went. So that's the first thing, a homogenous investor base.
Right.
The second is a misperception of risk, which might soon change. So actually calling something risk-free is a misperception of risk. The question is that likely to change soon? It may do, if things get bad enough. And the third is leverage. It doesn't mean leverage necessarily, or borrowing. It doesn't necessarily mean leverage in the instrument itself, but actually that's going to affect the behavior of the or economies, markets, but it's the behavior of the investor, the holder, that's important. If they have margin calls, if they have high leverage, then that's where the problem can come from.
So are you suggesting, not very subtly, that there's going to be a sequel to 2008 in the Western countries?
There could be. I mean, it's a very real scenario. We have, so far, if you like, reduced the high risk of a depression. But we've done that by flooding the market with extra liquidity. We've frankly been a bit slow, particularly in Europe, less so in the States, at restructuring banks and getting rid of the leverage in the banks. But there's still this big indebtedness. The
indebtedness, leverage, and basic belief in the risk-free nature of the bond yields?
I mean, to give you a little bit more, if you like, historical background, let's think about quantitative easing for a moment. Quantitative easing has been sold as something to stimulate the economy, but it isn't. Keynes' theory, as I've just mentioned, is all about avoiding a depression, which is in large part caused by mass uncertainty. If the central bank comes out, if Bernanke had come out and said, oh, we've got a risk of depression, and therefore we're going to pump lots of money in, that actually might create the uncertainty to create depression. So what he did instead is he sort of had two versions of reality, one for public consumption, which was, yes, QE is very good for the economy and stimulating, and then there was the real reason, which was to help the banks recapitalize. And this was in the absence of what normally happens in banking crisis, remembering we've had systemic banking crisis, including, artificially printing money since 1720. There are hundreds of examples. And basically, when you've got a banking crisis, you seize the bank, and you fire the management, you control where the lending should be going, you close bits down, and the government has to do that. We didn't do that.
You papered it over.
Yeah, we just papered it over, and it's because of that the central bank felt the obligation to fill the gap and avoid a depression. And that's why you have this extraordinary quantitative easing. So that's the history of quantitative easing. What we've done is, I mean, I tell a parable, if you like, a story.
Please.
And this is about dead bodies. So if you think about this massive indebtedness as a dead body, well, in the UK we have a dead body. Our debt to GDP is over 500%, but we know it's there. We know it's going to be tough clearing it up, and actually we're doing some of the right things, some of the wrong things, but we're actually doing pretty well, I think, at the moment. In continental Europe, they also have a dead body, but the dead body is around the edge of Europe. Germany's kitchen floor is spotless. Not only is it spotless, but they have all the cleaning equipment to clean up everybody's mess. But I think quite rightly they're arguing that if they're going to clear up this mess again, then they need proper rules to avoid some of the other countries creating more dead bodies. So there's big argument going on, and in the meantime the consensus reached is, well, let's take a big sheet and just put it over the body. So they did that. And then they realised they need a bigger sheet because the blood's sort of seeping out, and it's getting into your shoe leather, you see, and it's getting a bit sticky. So you just put a bigger and a bigger sheet on. This is denial. But the denial is even bigger in the States, because in the States they took the body, put it in a chair, gave it a cup of coffee, and tried to have a conversation with it. It was completely...
Smell the coffee, they said.
Exactly. and there's this... what Bernanke is trying to do, you see, is he certainly in the early days, post-08 period, he was the chief cheerleader saying that the emperor has wonderful new clothes. And just hoping that, by the time that the economy has actually recovered, nobody in the meantime has really noticed there's a problem.
Let's just take a break. We'll come back and chat some more with Jerome Booth and his book, Emerging Markets in an Upside-Down World.